Good evening, everyone.
Good evening, sir.
Good evening. Is my voice clear to all of you?
Yes, sir. Good evening, sir.
Good evening. Is my voice clear?
Yes, sir.
Okay. Thank you so much. So let us start with our discussion. So last class we have already discussed about the Marquis model. Okay. So today we'll discuss about another most important model for portfolio selection, that is CAPM model, capital asset pricing model. Okay. So I have already shared my screen. Just confirm me, is my screen visible to you or not? Is it visible to you?
Yes, sir.
Yes, sir.
Okay, good.
Yes.
So this model is developed by William F. John Linter in the year 1964. So this model is popularly used to determine the expected rate of return by considering two risks. Please remember. So the entire risk associated with investment instrument or financial asset can be categorized as two. The first one is systematic risk and the second one is unsystematic risk. So generally systematic risk is fixed. Please remember, why systematic risk is fixed? As we have already discussed in our previous class, systematic risk is driven by the macro factors. That means external factors. It is not within our hand. That means it is not within the hand of the entity who is going to issue the security. So systematic risk attached to the security or financial of security. Please remember, systematic risk attached to each security. Suppose you are buying one financial asset or one security. Let's say that security is A. If you are buying that security, that means in financial asset A, two types of risks are there. One is systematic risk and the second one is unsystematic risk. So since systematic risk is driven by the macro factor, external factor, so this will remain fixed. So systematic risk attached to the security will remain same irrespective of the number of the security you are holding and the amount of the security you are changing in your portfolio. So how we can able to optimize the risk and return? Optimization of risk and return means minimization of risk and maximization of return. Then only you can say there is optimization of risk and return. So risk and return can be optimized by way of portfolio diversification. Portfolio diversification means what? Please remember, by way of managing on systematic risk. Because systematic risk is not in our control. This is purely driven by the macro factor. So what is in our control? Unsystematic risk. So risk and return, as per CAPM, capital asset pricing model, risk return can be optimized by way of portfolio diversification. That means by way of managing the unsystematic risk. Is it clear? Did you understand? Yes or no?
Sir, if we take in portfolio diversification, sir.
Portfolio diversification means if you are changing the composition of your portfolio by way of changing the number of securities or by way of changing the amount of your securities. Whatever the amount or number of security you are changing in the portfolio, in the composition. Suppose you are dealing or you are holding 4 assets in your portfolio. That means asset A, B, C, D, like this. Okay. So whatever you are doing, that means if you are changing the asset A with another asset, or if you are changing the number of securities, suppose from asset A you are holding 10, you can change up to 20. Or if you are changing the amount also. So whatever you are doing,
payment boli out कम जोटा ମୁଁ ତାଙ୍କୁ ଦେଇଥିବି ବିକ୍ରି ହେଇଥିବ ମୁଁ ଦେଖିଥିବି ଯୋଉନେ ପେମେଣ୍ଟ ହେଇଯାଇଛି ମାନେ କଲେକ୍ସନ ଆସି ଯାଇଛି
Rajiv Babu, mute yourself. Okay. So how we can diversify the risk? We can diversify the risk by managing the systematic risk. Is it clear? Did you understand?
Yes, sir.
Sir, what is
Okay.
the third point? Sir, what is the third point? Systematic risk attached to the
Third point, systematic risk attached to the security is same irrespective of the number of amount of security. Irrespective of the number or irrespective of the amount of the security. What may be the number or what may be the security? Just a minute. Okay. So here in third point, the means what systematic risk attached to the security is same, irrespective of the number of security or amount of the security. So here I am just sharing my notepad actually. Is my notepad visible to you?
yes, sir.
Okay. So here, let us take, here I am creating a particular portfolio. I am creating a particular portfolio. This is my portfolio. Is it visible?
Yes, sir. Yes, sir. Yes, sir.
Okay.
Yes, sir.
Yes.
Good evening. So let's say I am creating this particular portfolio. In this particular portfolio, what I am doing actually, I am just putting some asset. Asset A is there, asset B is there, asset C is there, asset D is there. Are you getting my point? From asset A, let's say I am holding 10 number. How many numbers? Asset A
Yes.
means it may be equity share. From asset B, let's say I am holding 10, another 10 preference share. This is, let's say, equity share. This is preference share. Here I am holding, let's say, 20 debenture of any company. Okay. And asset B is, let's say, bond. I am holding 25 bonds. Okay. So the amount is 10, let's say 10 is 100. Here, this 10 is also 100 rupees. Here 20 is 200 rupees. Here 25 is 250 rupees. Is it clear?
Yes, sir.
Each instrument is 10 rupees. Are you getting my point? So
Yes.
this is my portfolio. So CAPM, this CAPM model is saying, what it is saying, this CAPM model is saying that this portfolio is having two risks. How many type of risk? Two risks. What are these two risks? These two risks
Systematic
is
and
systematic risk and
And
unsystematic
on
risk. Okay, unsystematic risk. Systematic risk cannot be controlled by ourselves, because it is purely driven by the macro factors, macroeconomic factors. But to some extent, we can able to control this unsystematic risk because this is driven by the internal factors or micro factor. Is it clear? Did you understand?
Yes.
Yes, sir.
Yes or no? So this systematic risk, that means since it is driven by macro factor, this systematic risk will remain constant for each and every security. Each and every security means, please remember, for A, what is the risk, systematic risk associated? That is fixed. For B, what is the systematic risk associated? That is also same. For C, what is the risk associated? Systematic risk. That is also same. Why? Because it is driven by the external forces. But how we can diversify the risk? We can diversify the risk by changing the number of securities in the portfolio. Right now we are holding 10 number of equity share. We can change up to 15 number of equity share. Right now we are holding 10 number of preference share. You can change from 10 to 5 number of preference share. So number you can change, side by side amount of security you can change. So whenever you are changing, that means you are diversifying. What you are doing? You are only managing the unsystematic risk. You are not managing the systematic risk. Are you getting right now?
Yes, sir.
This is
Yes,
the
sir.
third.
Yes, sir.
Is it clear? So this is the third part. That means security risk attached to the security is same irrespective of the number and amount of security. So here, risk and return can be optimized by way of portfolio diversification. That means by managing the unsystematic risk only. So how we are managing this? We can take this particular diagram. So here I am drawing this diagram for your better understanding. You just tell me whether my notepad is visible. Is it visible to you?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, very good. So let's say here I am drawing one diagram. That diagram is like this. Just this is x-axis. Hi, Yani. Yes or no?
Yes, yes,
Yes,
sir.
sir.
And this is y-axis. So x-axis, what I am taking actually, I am taking the return. In x-axis, I am taking return. Return means return of the security. This is my origin. Here in in y-axis return, in x-axis the number of securities. I may hold n number of securities in my portfolio. So this is my number of securities. So the securities, number of securities may be this is 1, 2, or 10, 20, 30, 40, like this. Yes or no?
Correct, correct.
That means we have, as we have already discussed, the systematic this systematic risk will remain fixed. That means it is parallel to the x-axis. Are you getting my point? This is
Okay.
remain fixed. If you
Yes.
are holding in your portfolio one security, what is the systematic risk attached? If you are holding two, the same systematic risk is also attached. Are you getting? The
Okay,
systematic risk of the portfolio will remain constant. Then how we can able to manage the risk? We can able to manage the risk like this. So this is known as unsystematic risk. Please remember. So if you are holding only one, here one, if you are holding only one security, then your degree of risk may be here. Here. That means here it may be your degree of risk. Okay. So if you are holding, let's say 5 or 10 securities, automatically the risk will be decreased. Yes or no? So if you are holding one security only, this is your degree of risk. If you are holding 5 securities, this is your degree of risk. Please remember.
Yes.
Are you getting a point? So
Yes, sir.
risk is only under unsystematic risk. This cannot be because systematic risk is driven by macroeconomic factors, so that will remain constant. Is it clear?
Yes, sir.
Sir, in
Did
y-axis
you
we are
understand?
keeping, in y-axis
Return.
we are indicating return, no, sir?
Yes,
Return,
yes.
return. In x-axis, that means why your variability of the return is there? Because of your what you can risk. Okay, because of the risk. Actually, this is not return. This is variability of the return. I have written wrong actually. So just a minute, I am rectifying. Variability. So variability of return means fluctuating of return. Why return fluctuate? Return fluctuate because of degree of risk. So this is in y-axis, we have to consider the degree of risk. Are you getting my point? This is not return exactly. This is variability of the return, degree of risk. So that's why the risk from here, it is going to decrease. Okay. Sometimes if you are managing the systematic risk very well, you can able to manage your systematic risk from here to your, unsystematic risk from here to systematic risk. It can, what you can say, align with your systematic risk line. Is it clear? Did you
Sir,
understand?
yes, sir, but little confusion. Can you please repeat it again? The second point.
Second,
On
which
security.
one? Second point means
Variable risks.
variability
Sir,
of return.
variability.
This is exactly not return. Actually, in just previous, just before, I have already written it. This is return, but this is not return. This is variability of the return. That means
Degree
fluctuation
of
of
risk.
return.
Okay.
Fluctuation of return. So why return fluctuate? Because of the degree of risk associated with the return. Okay.
Okay, sir.
Is it clear? So
Yes,
that's
sir.
why the risk can be gone down and it can just what we can say coincide with systematic risk. But below that it cannot do. Is it?
Okay, sir.
Chalo. So this is how we are talking about this CAPM. So I'll just explain about the CAPM. Before going to explain about CAPM, we must understand these two. One is capital market line and second one is security market line. So CAPM is derived from security market line. So what is capital market line? First we must understand, then we must understand what is security market line. So capital market line means what? It defines the relationship between the total risk and expected return of the portfolio, that consisting of the risk-free asset and the market portfolio. Are you getting my point? Capital market line means what? It defines the relationship between the total risk and expected return of the portfolio, that consisting of risk-free asset and the asset of the portfolio. Because in our portfolio, what we are considering? We are considering some asset. That asset can be compared with your risk-free asset, so as to determine the total risk as well as expected rate of return. So please remember, this capital market line generates a line where efficient portfolio can lie. Efficient portfolio can. Okay. So as
Sir, this is
Well,
not clear. Sir, can you please explain once again?
which one?
That graph, whatever you are showing.
This graph. Okay. That means it generates a line where efficient portfolio can lie. So in y-axis we are taking here in this capital market line, what we are taking? Actually, we are taking risk in x-axis and return in y-axis. Okay. So this is the line. Is it visible? This line. That means I can just mention. This is the line. Look here. Is it visible? This is the line. This line is known as your capital market line where efficient portfolio can lie. That means just below this line, some assets are there. These are some assets. Please remember, these dots are some assets. These assets are lie below the capital market line, and above the capital market line, again, some other assets are there. Other assets means other financial instruments or financial securities are there. So this is known as capital market line by taking the return and risk into consideration. Risk means standard deviation. Okay. And return, why? Because when return is more, when the return is gone down, that means here return is gone down as well as your risk is also gone down. Okay, so this is the capital market line where your efficient portfolio can lie. Efficient portfolio can lie on this capital market line. Please remember. So,
Sir, what is written in the y-axis?
y-axis is return, x-axis risk. I am just talking about capital market line. Are you getting my point?
Sir, efficient portfolio line is lies.
Efficient portfolio line. This is the efficient portfolio line. This line I have already shown you. This is CML, capital market line. That means efficient portfolio lie on the capital market line. This line is known as CML, capital market line, where the efficient portfolio can lie. Efficient portfolio means it is having lower amount of risk and higher amount of return. And there are some lower risk asset which lies below the capital market line, and there are some higher risk assets which lies above the capital market line. Is it clear? So this is about your capital market line. Coming to the
Sir.
second one. Yes.
Sir, actually it was not clear to me. Actually, x-axis along with x-axis we are keeping risks and y-axis return. When risk is less, return is maximum, and when risk is high, risk is more, return is less.
Risk is more.
If in x-axis, if we are keeping risks, but as per my understanding, I am not very clear in this. That's why I'm telling.
Okay. I am just sharing my note. There I am just explaining for your understanding. Just tell me, is my note visible to you?
Yes, sir.
Just a minute. Okay. This is x-axis, this is y-axis. In x-axis, what we are taking? We are taking return. Here we are taking risk. Okay. So what we'll do actually here, we have to create a particular line. Okay. So this particular line is known as CML, capital market line. Why it is known as capital market line? Because it is saying that where the efficient portfolio can lie. These are the various assets. That means if you are choosing this asset on the basis of capital market line, then we can able to get more return by taking less amount of risk. That means below to this line, some assets are also there. Some other financial assets are there. Below the capital market line, what are the assets are there? This is known as the lower risk assets. Oh yeah, okay. But above the capital market line, this is above the capital market line. Again, some assets may be there. These assets are known as riskier assets. Okay, that means this is a particular line. It generates. Okay, by taking the risk and return into consideration, where the efficient portfolio can. Is it clear? And here for capital market line, the risk can be determined by taking the standard deviation. Is it clear?
Yes, sir. Now
Okay.
it is clear.
Okay.
That means,
This is-
sir, the line, capital market
Yes.
line, is going up in the right side, no? Not down to the x-axis.
Not down the.
Whatever you have sketched there, drawn
Yes,
there.
yes. The reason is very simple. When risk is more, return will be more. But in between that, we have to choose some assets which are having lower risk and higher return. And that assets must be included in the portfolio.
Sure, sir. Thank you.
Clear?
Yes, sir. Clear.
Okay. So let us move to next. Next is about security market line. Okay, as I have already told you, is that just tell me, is my screen
I am
visible?
just scrolling through my actually.
Is it visible?
No,
Yes
sir.
or no?
Yes,
Yes, sir.
yes, sir.
Visible.
Yes, sir. Just now. Just
Okay, just now. ठीक है चलो security market line SML. So on the basis of this security market line, actually capital asset pricing model is determined by William F. Sharpe and John Linter. So it considers two risks. One is systematic risk, another one is unsystematic risk. We have already discussed. Again, it considers also beta. Beta means what? Risk coefficient of individual security. Suppose you are holding 4 security in your portfolio. Security A, security B, security C, security D. So A is having some risk. There are some risks associated with A, associated with B, C, and D. So what are the risks associated with individual C known as beta? So beta is the of individual security.
Sir,
So
voice is
complete
breaking, sir. Sir, voice is breaking, sir. So please repeat again.
beta is the risk coefficient of individual security. Beta security means in your portfolio, let's say if you are holding security A, so security A is associated with some risk, B is associated with some risk, D is associated with also some risk. That risk associated with individual security is known as beta. So beta is the risk coefficient of individual security. Clear? Yes or no?
Yes.
Am I audible?
Yes.
Okay.
Yes.
So how we can able to make the complete diversification of the portfolio? We can able to make the complete diversification of the portfolio when we are making the unsystematic risk zero or nil. When the unsystematic risk will be zero, what will happen? That means there will be only one risk. That is your unsystematic risk. We have already taken here. You can see here. This unsystematic risk can be coincide to the systematic risk. Once it will coincide to the systematic risk, then we can say unsystematic risk is zero. That means the total risk associated with the portfolio is only systematic risk. Clear? So here, whenever we are going to determine the portfolio, what we are doing, we are just comparing the comparison between beta and expected rate of return. Okay. So expected rate of return is purely driven by the beta. Beta means what? Risk coefficient. Risk coefficient. Okay. By taking this, we can able to create the Sapm model. So this is the Sapm model. You can see the relationship between risk and return established by the SFL. That means security market line is known as Sapm. By taking the security market line, if you are establishing the relationship of the what risk and return, that is known as Sapm. So higher the beta means if the beta coefficient is more, it indicates the risk coefficient of the security is more. So since risk coefficient of the security is more, it can give you higher return. So mathematically, as we have already taken, expected rate of return is equal to RF means risk-free rate of return plus beta coefficient, that is the risk coefficient, and multiplied with RM minus RF.
Market
What is
rate.
RM minus RF?
Market
RM minus
rate.
RF is the premium. Is it clear?
Yes, sir.
Did you understand?
Yes, sir.
Yes, sir.
Okay. So here the notation I have already mentioned. ER stands for expected rate of return and RF is the risk-free rate of return of the security. RM stands for market rate of return. We are expecting if we are dealing with that security from the market. Beta is the risk coefficient associated with the individual security. So RM minus RF indicate the premium. The difference between market rate of return and risk-free rate of return is the premium. We have already discussed.
Yes, sir.
Okay. So when William Epser developed this particular model, it has also taken some assumptions because without assumptions, you can able to derive any theory or any model. Why? The reason is very simple because anyone can challenge you if you are not considering some assumptions or some conditions. On the basis of certain conditions or certain assumptions, William Epser and John Linter, they have developed this particular model. What are the assumptions? Let us see. So the assumptions are that means investors are risk avoiders. Risk avoiders means they don't want to take the risk. No investor want to take a maximum amount of risk or no investor want to assume more amount of risk. That means diversification is quite essential to reduce the risk. What is the first assumptions? Investors are risk avoiders or risk averse. They don't want to take the risk. So diversification is needed to reduce the risk. That's why diversification of the portfolio is required to reduce the risk. Okay. So next one is all investors have identical estimates of risk and return of all securities. By considering the information, market information, what are the risk you are estimating or what are the return you are estimating from the security, the same risk and same return I am also estimating as an investor. So all investors have identical estimation. Identical estimation means similar type of estimation on the basis of the market information for determination of risk and return. Okay. And next condition is that means next assumption is that all investors can borrow or lend an unlimited amount of fund at the risk-free rate of interest. Let's say you are one investor, you can borrow or you can lend the fund. Where you can borrow or where you can lend the fund? Market, because so many buyers and sellers are there. So from the market, fund is available, you can borrow or lend the fund an unlimited amount, no restriction is there, at the risk-free rate of interest. Risk-free rate of interest means you can consider that is your FD rate or bank rate that is prescribed by your RBI. Is it clear? Did you understand?
Yes, sir.
Yes or no?
Yes,
And
sir.
coming to
Yes.
other assumptions. Okay. So all investors want to maximize the wealth, and the portfolio selection is on the basis of risk and return. What is the next assumption? That means all the investor wants to maximize their wealth. How they can able to maximize their wealth? By way of capital appreciation or capital gain, as well as coupon rate of interest or dividend. And the portfolio selection is on the basis of risk and return. Whenever, as an individual investor or as a what you can say institutional investors, what is how to select the portfolio? You can select the portfolio by considering two. What are these? Risk and return. These two elements are more essential in order to select the portfolio. This is another assumptions. Next one is no transaction cost or tax. Transaction means what? Whenever you are dealing with the security, you have to buy the security from the market. Again, you have to sell the security from the market.
Yes, sir.
During
That's
your buying
correct.
and trading process, you need to you need to go for transaction. Yes or no? So whenever you are making any transactions, some transaction costs are there or transaction tax are there. In our first class or second class, someone has asked about what you can say transaction tax. Okay,
Yes.
so that transaction cost or transaction tax must be absent. That is another assumptions. Okay. Next, security market is efficient and must not influenced by
Sir, is
uh,
that does it mean that STT?
security transaction tax.
Okay. Okay.
Okay. Security market is efficient one and cannot affect by sales or purchase price. Okay. So security market is efficient one and must not be influenced by the trading price. Trading price. Trading means what? Buying and selling price. Security market is efficient. Efficient means all the information must be available to all the participants in the market. And the security price must not be influenced by the trading price. So these are the assumptions taken by William F. Sharp and John Linter in order to develop the Sapm model. So these are some limitations or criticisms they have already faced. So what are the limitations? Limitations is that we are determining the expected return based on the future expectations. Yes or no? It is all about future expectations, but future is uncertain. Please remember. So this is one limitation. Second one is beta is unstable. We are talking about beta is the risk coefficient of individual security. So since it is the risk coefficient, so it may be unstable. It is volatile. We cannot say that risk associated with this security will be remain fixed. Okay. Again, third criticism is that only this model focus on systematic risk. It is not focusing on systematic risk, but there are some unsystematic risk may be associated with the portfolio. Okay. Again, security market line is not appropriate appreciation for bond analysis or appropriate application for bond analysis. Security market line can be utilized or used for what you can say equity or preferential stock instruments, but it is not applicable for bond analysis. So this is also another limitation of this particular model. Did you understand?
Yes, sir.
Sir, if we take in
Okay.
second point, sir.
Which one?
Sir, second
Second.
point.
Beta is unstable. That means beta is volatile. It can fluctuate. We are talking that whenever we are picking any security, let's say I am picking security A. So some risk associated with security A, that risk I am saying that beta. So beta may not be what you can say fixed. That is unstable. That can be changed. That means it is changeable.
Yes.
Clear?
Yes, sir.
Up to this, any doubt? Chalo.
Sir, no,
Next.
sir.
The difference between capital market line and security market line. We have already discussed about capital market line and security market line. Please remember this is the first column. We are taking three parameters. Okay. What are the three parameters? Risk, risk coefficient, and theory. By taking these three parameters, we are just making the distinction between capital market line and security market line. So capital asset pricing model is derived from this security market line. So whenever we are considering risk, capital market line consider the total risk. But in case of security market line, it only consider the systematic risk. It is not considering the unsystematic risk, because total risk is the summation of systematic risk and unsystematic risk. Is it clear?
Yes,
Did you
sir.
understand?
Yes,
Risk, if we are talking about risk coefficient, capital market line risk coefficient is determined by that is sigma. Okay, sigma means what? It is the risk coefficient of your entire portfolio. But here, beta is the risk coefficient of individual security. In your portfolio, there may be varieties of securities and variety composition of securities. But whenever we are talking about in security market line, it is considering the risk coefficient as the beta. Beta means the risk associated with individual security, not all security in the portfolio. So standard deviation is the risk of the entire portfolio. Beta is the risk of the individual security. Did you understand? Yes or no?
Yes, sir.
Yes, sir.
Again, third one is theory. That means the capital market line is purely determined from the capital market theory, CMT, capital market theory. But security market line is determining from the APT, asset pricing theory. So on the basis of this CAPM, that means security market line, we can able to determine the CAPM, capital asset pricing model, through which we can able to compute the expected rate of return of the security. Is it clear?
sir. In risk coefficient, sigma is associated with.
Sigma is associated with the risk of the total portfolio. Beta is the risk coefficient of the individual security. Portfolio means what? In your portfolio, you may put n number of security. N number of security means n variety of security with various numbers or various compositions. Clear?
Correct, sir. Correct, sir.
So I have already taken one example. Okay, slide is not changing. Now is it visible?
Yes, sir.
There are two assets. Asset A is there and asset B is there. This is the risk-free rate of return and this is the market rate of return. And this is the beta coefficient associated with individual security. So how many assets are there? Two assets, asset A and asset B. So security A and security B is there. So what is the degree of risk associated with security A? 1.5, that is beta. Risk coefficient of security A is beta and risk coefficient of security B is 1.
1.
Here 1.5, here 1. Market rate of return for these two are given 20% and 18% respectively. And risk-free rate of return for both the assets, both the securities are same. That is 8%. Okay. So this is the expected return for asset A and expected return for asset B we are going to determine. How to determine? We have to follow this model, CAPM model. RF plus beta into premium. Premium means RM minus RF. Is it clear? So for asset A, what is the risk-free rate of return?
That is 8.
8%, that is 0.08. Yes or no?
Yes,
Plus
sir.
beta. Beta is 1.5 into premium. Premium is equal to RM minus RF. RF here is 20%. And RF is 8%. 20 minus 8 is 14%. So 0.2 minus 0.08.
Okay.
That is 0.14. If we solve this, how much you are getting? You are getting 0.26. That means 26% is the expected rate of return for asset A or security A.
Okay.
In the same way, we can also able to compute the expected rate of return for asset
B.
Clear?
Yes, sir.
Did you understand?
Yes, sir.
So
Understood.
this is all about capital asset pricing model, capital market line, as well as security market line and their distinction. Clear?
Yes, sir. This remains this.
Ashutosh sir is asking again, please, sir. Which one? Ashutosh Babu, can you
सर एई गोटा आउट रे बुझी सर
এই গোটাক হচ্ছে asset A B ଆମେ ଦିଟା ନେଲେ ଦିଟା asset ର risk free rate of return ଦେଇଛି asset A ର risk free rate of return ଦେଲା 8% B ର ବି ଦେଇଛି 8% market rate of return କେତେ ଦେଇଛି for A 20% for B 18% बीटा माने risk coefficient associated with individual security ଏଇ जो asset A যদি ଆପଣ କିଣିବେ यार risk coefficient କେତେ ଅଛି 1.5 that is also available market okay risk coefficient that is your 1.5 for B risk coefficient is available that is 1 now we are going to find out the expected rate of return for asset A that means security A and security B so in order to determine the expected rate of return for A what is the model F plus beta into RM minus RF RM minus RF is the premium so at a risk free rate of return A ର କେତେ ଅଛି କୁହନ୍ତୁ
8
8 sir 8% 8%
so ताको ମୁଁ ଲେଖିଲି 0.08 plus यार बीटा कोएफिशिएंट केते अछि 1.5 ताको ମୁଁ ଲେଖିଲି 1.5 multiplied with RM minus RF A रो RM market rate of return केते अछि 20% that is 0.2 minus risk free rate of return केते अछि 8% that is 0.08 याको ମୁଁ जदी सॉल्व कली पाइली रिजल्ट केते 0.26 so 0.26 means 26%. Okay. So in the same way, if all the information available in this particular model, I can able to get the answer as 0.18. That is 8%. If I am picking asset B, I am getting 8%. If I am picking asset A in my portfolio, I am getting 26% rate of return. Side by side, you have to also consider, look here, in asset A, what is the risk? 1.5. In asset B, what is the risk? In asset B, what is the risk? 1 अछि. Then
1 ଅଛି
risk କୋଉଥିରେ risk କମ ଅଛି? Asset A ନା asset B ରେ?
Asset
Asset B ରେ risk କମ ଅଛି. Asset B ର return କେତେ?
18% ଅଛି
Asset A ର risk ଅଧିକା ଅଛି 1.5 ତାର return କେତେ
20% 20%
26% not 40 26%.
Sorry, 26.
So when risk is more return is more when risk is less return is
हां सर थैंक यू सर
So when beta is 1, then risk is
moderate
Yes.
moderate more than 1 it is riskier less than 1 it is having low risk ठीक है did you understand
yes sir
sometimes in your exam also
Yes, sir.
you can get 5 marks question or 8 marks questions like distinction between CML and SML
Okay.
okay this is very simple if you write the distinction suppose this 3 only this 3 point risk coefficient theory if you write only this 3 point also you'll get 5 to 5 marks
Yes.
this is very simple
Thank
सर एटा एचटीएमएल सर एटा कहले सीएमएल सेही भलिया ना
CML रो कहली पर टोटल रिस्क एठे स्टैंडर्ड डेविएशन कैपिटल मार्केट थ्योरी यार थ्योरी के को थ्योरी हम डिटरमाइन करछन CML कैपिटल मार्केट थ्योरी
हां
कैपिटल एसेट प्राइसिंग मॉडल को थ्योरी हम डिटरमाइन करछन एसेट प्राइसिंग थ्योरी रो बुझी पल्ले ना नहीं
ओके सर हां सर
ओके
you. Yes, sir.
up to this clear
ओके सर
Yes.
okay thank you so much so
Sir.
next yes please
Sir, like the yesterday ଗୋଟେ question ଦିଆ ହେଇଥିଲା ସେଟା ମାନେ solve କରିବା
Yes,
ପାଇଁ
sir.
okay କରିଛନ୍ତି solve very good
नहीं सर सेटा टिके आंसर केतिला टिके कंपैरिजन करिया तला एंड रे करदवा 5 मिनिट क्लास पर
5 मिनिट क्लास पर केतेबेले हमर क्लास
नहीं
करूछु
क्लास एंड हवा थो 5 मिनिट पूर्व करदवा सेटा टिके क्वेश्चन कंपैरिजन का
7:30.
क्लास
7:30. What is the time right now?
7:18.
7:18. So let us compare.
यस सर वी कैन
Let us just cross verify your answer. Then, if possible, we'll proceed to next.
सर आज ही सर यस
Okay. No, as you wish.
ओके सर थैंक यू सर
Okay. So what will do? Tell me.
Sir, the class should be continued and before
Okay.
conclusion we should.
Very good. Very good.
Thank you.
Thank you so much. So let us discuss about arbitrage pricing theory. So once again, I'm just sharing my screen. Just give me few seconds. Yes, please. Tell me. Is it visible?
Yes, sir.
Yes, sir.
Okay. Good. Arbitrage pricing theory. This theory by one popular economist. The name is Stephen Ross in 1976. So there are 4 factors which explains risk premium relationship of a particular security. We have already discussed about Sapm. Okay, capital asset pricing model. But here, whenever we are going to determine the price, that means the return of any security, so we have to consider the 4 factors. Okay, so Stephen Ross has taken 4 factors which explain the risk premium relationship of a particular security. So expected return on an investment is dependent upon how that investment react to a set of macroeconomic factors. CAPM रे हमें कौन नेले जतबेले CAPM कहउछंती it is only consider the systematic risk. So systematic risk is driven by macroeconomic factors. So macroeconomic factors means there may be n number of factors.
Yes, sir.
हो ना नहीं?
Yes, sir.
So Stephen Ross कौन कले ना out of n number factor it only consider the 4 factors, any 4 factors in order to determine the expected rate of return from the security. So these macroeconomic factors, that means degree of the reaction being measured by beta. अबे जो बीटा कहले systematic risk पूरा में जो risk रा coefficient का में कौन नोचोदी बीटा, that is the risk coefficient of individual security. For individual security, risk is associated with systematic risk. If you are managing or diversifying our portfolio, then unsystematic risk tends to 0.
Yes.
Yes or no? So degree of reaction being measured by beta. So this is driven by macroeconomic factors. So what are the specific macroeconomic factors Stephen Ross has taken? 4 macroeconomic factors. Out of n number of macroeconomic factors, he considered 4 macroeconomic factors. And the risk premium associated with each of these macroeconomic factors he has undertaken. Clear?
Yes, sir.
So by undertaking these macroeconomic factors, according to CAPM, this is the model. Yes or no? ER, expected rate of return, is equal to RA plus beta into premium.
Yes, yes, sir. Correct, sir.
हाँ या नहीं बोलो?
Yes, yes, sir.
Yes, sir. Yes, sir.
Okay. So according to APT, the same model Stephen Ross considered, but this beta is driven by how many macroeconomic factors? 4 set of macroeconomic factors. Okay. So these are the 4 set of macroeconomic factors. Please remember. This is 1, this is 2, 3, 4. Yes or no?
Okay.
Did you understand?
Yes, sir.
So expected rate of return according to arbitrage pricing theory is RA plus lambda 1 into beta 1, then lambda 2 into beta I2 means beta 2, lambda 3 into beta 3 plus lambda 4 into beta 4. Is it clear?
Yes, sir.
Okay. That means he has taken the macroeconomic factors out of set of macroeconomic factors, only 4 macroeconomic factors. Now question is that, what are those macroeconomic factors? These are the macroeconomic factors identified by various researchers. So when it is identified by various researchers out of n macroeconomic factors, Stephen Rush considered only any 4 which can influence the risk of the security. Is it clear? Yes or no?
And no,
So
sir,
these
can
are
you
the
repeat it again, sir?
out of n number of macroeconomic factors. How many factors Stephen Rush considered
4.
in order to determine FPT?
4, sir.
4. So
Hmm.
what are those macroeconomic factors? These are the macroeconomic factors identified by various researchers. So what are macroeconomic factors? Changes in GDP. Can you control GDP of a country? As individual entity or individual corporate, individual investor. Are you getting my point? So changes
Yes,
in
yes.
GDP, that is macroeconomic factor, changes in inflation rate, macroeconomic factor, changes in interest rates, changes in industrial production, changes in level of personal consumption, changes in level of money supply to the economy. So these are the various macroeconomic factors. Out of these various macroeconomic factors, he considered any 4. You can say, sir, which 4? Any 4. That means he has considered any 4 out of n number of macroeconomic factors in order to develop this APT, arbitrage pricing theory. Okay.
Yes, sir. Yes, sir.
So this is the arbitrage pricing theory according to this arbitrage pricing model. Arbitrage pricing theory we have. So he has developed arbitrage pricing model from the arbitrage pricing theory in order to determine the expected rate of return. Okay. So expected rate of return is equal to RA plus this is beta instead of beta BJI, that means first risk coefficient plus RP1, again BJI plus RP2 BJN plus so let's go through these notations. ERJ stands for risk assets, risky assets, expected rate of return. Whenever we are taking any risky assets, what are the expected returns associated with these risky assets? RPN stands for risk premium of the factor. Risk premium of the factor means by taking a particular macro factor, what is the risk premium associated with? Suppose we are considering changes in the inflation rate. That is one macroeconomic factor. By considering this macroeconomic factor, what is the risk premium associated? And RF is the risk-free rate. BJN stands for sensitivity of the asset to factor N. N means N number of macroeconomic factor. Okay, sensitivity. Sensitivity means, please remember, this is exactly your beta. That means risk coefficient. Sensitivity means what? Risk coefficient the asset to factor N. N means changes in inflation may be one factor, changes in GDP may be another factor, changes in interest rate may be another factor. So what is the risk coefficient associated with the asset whenever we are taking n number of factors? That means 1 factor, 2 factor, 3 factor, or 4 factors. Okay. By considering this, we can able to determine the expected rate of return from the risky assets. Is it clear?
Yes.
Did you understand? So this arbitrage pricing theory is considering this arbitrage. What is arbitrage? Do you know? What is arbitrage?
Sir, arbitrage
Yes or no? It is the practice of taking advantages of a state of imbalance between 2 or more markets and thereby making the risk-free profit. Let's say USA is one market, India is another market. In USA inflation rate is there. हाँ या नहीं बोलो?
Sir, yes, sir.
In USA GDP is there. In India GDP is there. हाँ या नहीं?
Yes, sir.
Yes, sir.
So by taking these factors, let's say inflation rate is less in USA than in India. So automatically the risk free, but lower risk asset would be higher.
Sir, sorry to say your voice
Return.
is breaking, sir. Sorry.
Advantage means what? Price of take, that means it is the practice of taking the advantages of a state of imbalance between 2 or more markets. India market and USA market. So let's say in USA market, assets are lower risk, but they are giving higher return. But in India market, assets are riskier, but they are giving lower rate of return. So what you need to invest? You invest in USA market in order to get more return by taking less amount of risk. Thereby, you can able to take a risk. That process is known as IRS. Clear?
Yes, sir.
All of you, did you understand?
Yes,
This
sir.
is all pricing theory and arbitrage price, APT and APM. Is it clear?
Sir, from
Yes,
this
please.
any mathematical question will come from this arbitrage theory?
Madam, ଟିକେ ଜୋରରେ କୁହନ୍ତୁ ଶୁଣେ।
Sir, କିଛି mathematical question ଆସିବ କି sir?
ଖାଲି ଯେ ମ୍ୟାଥମେଟିକାଲ ସେମିତି ବା କିଛି ଯଦି ଆପଣଙ୍କୁ ଦେଇଥିବ ଯେମିତି ଏକ୍ସପେକ୍ଟେଡ ରେଟ୍ ଅଫ ରିଟର୍ନ କହିଲି, ରିସ୍କ ଫ୍ରି ରେଟ୍ ଅଫ ରିଟର୍ନ ଦେଇଛି, ବିଟା କୋଏଫିସିଏଣ୍ଟ ରିଟର୍ନ ଦେଇଛି, you just find out the expected rate of return for a particular security or particular asset. This type of question ଆସିପାରେ, bond analysis ଯେତେବେଳେ discussion କରିବା, valuation of bonds, okay, bond returns, bond duration, ତା ଉପରେ ବି ଯଦି ଆସିବ ଛୋଟ ଛୋଟ mathematical question
Sir,
ଆସିବ।
expected risks or standard deviation of return is same, है ना?
Standard deviation of the return. The
Yes.
expected rate means expected returns. Deviation indicates the risk associated with the portfolio. ଆମେ ଯେତେବେଳେ portfolio ବା individual security consider କରୁଛନ୍ତି, ଦିଟା ଜିନିଷକୁ ନଉଛନ୍ତି, ଦିଟା element କୁ consider କରୁଛନ୍ତି. What are those two elements? Risk and return. Okay.
Okay.
That's for expected rate of return. It is standard deviation no. Standard deviation माने कौन? Risk associated with the portfolio. ER means expected return from the portfolio.
Okay. तो सर नहीं expected risks को standard deviation of return भी same होता है ना, दोनों same एक ही है ना?
Standard deviation means expected risk by level of risk or degree of risk associated with the portfolio. ठीक है? और कुछ है तो बोलो, please.
Sir, my question for discussion.
अरे पछपटे
previous year question ଟିକେ ଦେଖନ୍ତୁ madam, okay? ଦେଖିଲେ ଆପଣଙ୍କର କିଛି ଆଇडिଆ ହେଇପାରିବ। ମୁଁ ଏତେ ତ
No,
କିଛି
sir, ନାଇଁ sir, କାଲି ଯୋଉ question ଟା ଦେଇଥିଲେ ସେଇଟା sir discussion କରିଥାନ୍ତି।
discussion କରିବା।
Sir,
Next class is there, I think 7:30. Whether sir has joined or not?
yes, sir.
Join କରିସାରିଲେଣି?
Yes, sir.
Okay, and tomorrow at the beginning of the class, I will discuss the question first, then we'll proceed.
Okay, sir. Thank you, sir.
Okay?
Yes, sir.
ଖାଲି ମତେ ଟିକେ କାଲି 12 ଘରେ ଆପଣ ମାନେ ମନେ ପକେଇଦେବେ।
starting ରୁ ମନେ ପକେଇ ଦବୁ।
ହଁ, starting ରୁ ମନେ ପକେଇବେ, ସେଟାକୁ ଆମେ clarify କରିବା, then we'll go for further discussion. Is it clear?
Thank you, sir.
Thank you,
Okay,
sir.
sir. Thank you.
Okay, first tomorrow we'll discuss that question, then we'll proceed to further.
Yes, sir.
Yes, sir.
We did
ठीक
it.
है?
We just want to clarify that is it correct or not.
Okay,
Yes, sir.
definitely we'll discuss.
Thank you, sir.
So,
Thank you, sir.
about today's discussion, if any doubt or any query, you can proceed. Otherwise, we are going to wind up the session for today.
Sure, sir.
Any query from your side?
Sir, sir, say APM formula रे कितने doubt ଅଛି sir काली
କାଲି ପଚାରିବେ?
Yes, sir.
Okay.
Sir,
Okay.
background now noise ଆସୁଛି ତ ସେଥିପାଇଁ।
Okay. ठीक. So
Okay, sir.
let us wind up the session for today. Thank you everyone once again for joining with me. Have a great time ahead. Good night.
Good night, sir.
Thank you, sir. Good night.
Abhishek Kumar Mishra sir, are you there? Abhishek Kumar Mishra.
Yes, sir.
Okay, you, right now you are the host actually. You just make the host to our sir. I think Ponda sir has already joined. Okay, you are the host. You just make host to Pandasa.
Okay, sir.
Please make it. Okay, then proceed. Thank you so much.
Good evening.
Good evening, sir.
Is it audible
Sir.
clearly?
Yes, sir. Good evening, sir. Good evening to you.
Good evening.
Good evening, sir.
So the screen is visible to you?
No, sir.
No, sir.
Sir,
Sir, please share the slides, sir.
Okay. Just a minute. Okay, the now the screen is visible to you.
Yes, sir.
Okay, let's start. Actually, in the previous class, just we had started regarding the origin, origin and the history of mutual funds. So, regarding the origin of the mutual funds, although it is believed that that the historians they are uncertain about the origin of the what are mutual funds. Some say that the closed-end investment companies launched at the Netherlands in the year 1822 by the King William I is the first mutual funds. But still, some other people they say that the Dutch merchant named Adrian van Kewich, whose investment trust was created in the year 1774, might have given the idea to the king. So there is a little bit of confusion regarding this concept. What is happening? technical problem. Now is it visible? The screen? Is the screen
No, sir.
visible? to you? Okay, okay.
No, sir.
No. I don't know the screen is. What is the problem? Oh, the meeting has been disconnected. Okay, 1 minute, 1 minute. Is the screen visible now?
Yes, sir.
Okay. So I was discussing regarding the origin of the mutual funds. Actually, the historians, they are not sure about the origin of this mutual funds. That is why there is a confusion between two ideas. One idea is that closed-end investment companies, they launched at the Netherlands in the year 1822 by the King William I, is the first mutual funds. But whereas some others, they have the idea that Dutch merchant named Adrian Van Kevich, whose investment trust was created in the year 1774, that might have given the idea to the king.
Sir, excuse me, sir. Sir, your voice is not clear, sir.
Okay, okay. Now it is clear?
Yes, sir. Yes.
Okay. So a further development of mutual funds was made in the Switzerland in the year 1849. and subsequently it was followed in Scotland in 1880s in the similar fashion. Then, consequent to the evolution of mutual funds, which was rooted in the Great Britain and France, the idea of pooling the resources and spreading the risk using closed-end investments came to the United States in the 1890s particularly. And the first closed-end fund, that is a Boston Personal Property Trust, it was formed in the USA in the year 1893. And the modern mutual fund evolution developed in the year 1970s in the Philadelphia under the name Alexander Fund, which had a special feature of a semi-annual issue and a facility for investors to withdraw their investment on demand. Okay. These also we had discussed in the previous class. Just I am recapitulating whether any doubts or dilemmas are there. That is why. Regarding the launching of the modern fund, that is in 1924, the modern mutual fund was created in pursuance of the formulation of the Massachusetts Investors Trust in Boston. Then another generation of a mutual fund firm, namely MFS Investment Management, went public in the year 1928. In view of these said setup, the first no-load fund was launched in the year 1928. So instantaneously, the first new launch of Wellington Mutual Fund emerged to include stocks and bonds as opposed to the direct merchant bank style of investments in the business and the trade. So there is a completely change in the mutual fund industry by the year 1928. Actually, as there is a competitive strategy, these mutual funds, they have adopted a competitive strategy. That is why they never follow any standard. To counter that, actually some sort of a regulation are required, and that is why some regulations has been developed for the mutual funds. You see, 19 open-ended mutual funds and nearly 700 closed-ended funds existed before the stock market crash in 1929. In the 1929, there was a big crash in the stock market. During that time, 19 open-ended mutual funds and nearly 700 closed-ended funds existed. And due to that crash in the stock market, the closed-ended funds were wiped out, and a few small open-ended funds, they managed to survive. So here, actually the government felt that there is a necessity to protect the interest of the investors. That is why the government regulations created the Security and Exchange Commission, ACC. And this ACC paved the way to enact the Security Exchange Act of 1934. As a result, mutual funds must register with the ACC and to reveal it in its prospectus. That means the mutual fund should mention in its prospectus that they have registered with the Security Exchange Commission, right? The mutual fund industry grew up gradually during 1950s with 100 top open-end funds, and in addition to that, 50 new funds emerged during the decade. Is that audible clearly?
Yes, sir.
Okay. Any issues?
No.
Good. Then these 100 of new funds were launched during the decade of 1960s, which had aggressive growth till the bear market condition of 1969. So here one question is that what is bear market? The market, there are two type of market condition. One is bear and another is bull. So bull means the market is increasing. Okay, that means the market is going up. That is bullish market. or bullishness. And a bear market is the market where the prices in the stock market goes down, right? These are the two trends in the market, bear and bull, or we are telling that market is either bearish or bullish. Able to understand these two trends in the market, bullishness and bearishness, or
Yes, sir.
bear market or bull market? Able to understand these two concepts very clearly?
Yes, yes, sir.
Good. So in 1969 particularly, there was aggressive growth until the bear market conditions of the 1969. In 1969, the market reached a very bad position, that is a bear market condition. And the first index fund concept was established. Before that, there was no index fund. Only the security funds were there, equity funds, and debt funds were there, but no index fund concept was there. And this index fund concept was established in 1971. And further, it flourished due to the impact of a low-cost index fund and the rise of a no-load
What
fund.
do you mean by the index fund, sir?
Index fund means here you see, instead of investing in the stocks, you can also invest in the index. Few index, example of a few index are Nifty 50, Bank Nifty, and Fin Nifty. Just I am making you understand how you need to trade upon them. Actually, you see there is what option price. If you go to the option price, then in the option price you will find that each and every index, they have a different rate for different strike rates. Okay, whatever the market rate is going on, accordingly there are price bands. On this basis of a price band, you are supposed to choose whatever the price you opt for that. So whenever you will opt for that particular price band, then there are a fixed quantity. For example, 50 stock, 50. The lot size is 50. That is the lot size. Lot size is 50 in Nifty 50. In Bank Nifty, it is previously it was 25, but now it is 15. And in the Fin Nifty, it is also its size is 20. Like this. That means whatever the price, prevailing price, that will be multiplied by the lot size. Then you are supposed to pay that much to acquire that that index, right? That means you can previously what people they were investing only in the stocks, but later on what there is also scope for investment in the index, because you see index are more volatile, index are moving very faster because it represents the entire stock market. You are able to follow me?
No, sir, not properly, sir.
Actually, you see, just I am giving you example. Suppose you see in the Nifty 50, what we are taking. In the Nifty 50, there are top 50 companies. That means blue chip companies are enlisted. So these 50 companies, they are moving up and down, but their total figure, that is so suppose the Reliance company will move up by 50 points, and your Nestle will move down by 30 points. So the resulting figure represent your index. That is what index fund. Now you able to understand? Instead of investing in the stock of a particular company, you can also invest in the index. So index movement is very faster as compared to the stocks, because stocks are a little volatile, but here index is highly volatile because it represents the total. It represents the average. That means suppose in a day, there are out of 50 companies, 30 companies will give positive movement and another 20 company will give negative movement. Whereas in the total, you will find a positive movement in the index. Thereby, you can make profit. Is that clear?
Yes, sir.
Okay.
Yes, sir.
Okay, so the first index fund concept was established in 1971 and further it flourished due to the impact of low cost index. Why? Because you see it is if you want to invest in the stocks, then you will find it a little bit costly. But the index, in the index, you can purchase one lot for 10 to 12,000. By 10 to 12,000, you can purchase a lot in the index. But stock option, to purchase one stock option, you are supposed to pay at least 70,000 or 80,000 like that. Right? That is why people, they are interested for this index, trading in the index. And on account of increasing globalization of finance, expanding presence of large multinational financial groups, and strong performance of equity and bond markets, the global growth of mutual funds boosted during 1990s. Okay.
Yes, sir.
Okay. Then what is mutual fund? That also I explained. This definition has been given by AMFI, that is according to the Association of Mutual Funds in India. A mutual fund is a trust that pools a number of savings investors who share common financial goal. That means here you see, that means the individual investors, as they have a common goal, that is for the either increasing the income or increasing in the wealth. These are the common financial goal. So to satisfy this common financial goal, when more than one person, that is what they turn their savings into a fund, and this fund has been managed by efficient person, that is what called a mutual fund, right? And from these above definition, we can understand the concept of a mutual fund and the key points as mentioned here under, that a mutual fund is a trust. Trust means what? It is a combination of many people. So that means what? Many people
Sir,
with this some common objective.
ordinance,
Yeah.
ordinance.
Ordinance.
Sir, trust means ordinance.
I'm not able to reach you. What you are speaking?
So she is asking meaning of worthiness.
Oh, acha, meaning of worthiness. Okay,
No,
okay.
no, sir. She is saying that the trust means worthiness.
A trust means worthiness. No. It is not. A trust means what? It is a actually whenever a few persons they combined their hand for a common purpose. That is what a trust. Okay, that means suppose you see for the management of temples, previously for the management of the temples, there was a trust. That means this trust is a combination of certain persons. They have a common purpose, that is for the smooth management of the temple. Wherever you are now going to the Puri temple and Lingaraj temple are there, each temple has its own trust. Okay, that means that it is an association of a person who having any common objective. That is what a trust, not a worthiness. Is that clear?
Yes, sir.
Okay.
Yes, I got it.
So here you see a mutual fund is a trust. That means it is a combination of people having a common objective. What is their common objective? Either to increase their income or to increase their wealth. Wealth maximization or profit maximization or the income maximization is the common objective. And mutual funds, what they pool the money from a group of investors called the unit holders. And these individuals who are forming or who are becoming the members of the trust, they are called unit holders. That means that suppose the total capacity of the mutual fund, a particular mutual fund is 1 crore, and the total number of members are suppose 100. Then unit holders, what is the size of the unit? That is 1 crore divided by 100. That will be the size of unit. And each individual members, they will purchase more than one or more than one unit, so that they will become the members. So whenever there will be actually now the total fund shall be utilized by the able managers, fund managers, in a better way in the stock market. That means some high risk projects are there, some low risk and some medium risk. So combinedly they are finding out which is the best possible alternative and invest the fund. And whatever the return, total return, it shall be divided by the number of units, so that the unit holders, they will get their proportional income. Is that clear?
Yes.
Or facing any difficulty in understanding?
No, sir, it's clear, sir.
Okay. So the investors, they share this common financial goal. And what is their common financial goal? What is the common financial goal of the investors?
To take a high
Sir,
return.
Income, that is income maximization and wealth maximization. These are what are basically the common financial goals of each investors. Okay, and they invest the money, and this money shall be collected from the small investors into the security, that is shares or bonds, and it is called the diversified investment. As you know, why I told you that diversification is required in case of the investment. Why? Because we should not carry all of our eggs in one basket. So whenever we are investing in any project, some certain
To minimize risk, sir.
Yes. So there is some sort of a risk is associated to each investment opportunity. That is why we need to calculate what is the exact risk involved in that. And similarly, whatever the alternative investment opportunities are there, we need to calculate their respective risk. And as a result of what, we will take the decision accordingly to how much risk we can take and how much return we need, and that can be done by the diversification. Otherwise, what, in one project if you invest your entire amount, then as risk is associated, there is a chance that the entire fund may vanish, right? So this is what called your diversified investment. And mutual funds, they use professional expertise, that is what investment management skills on investment made, and asset classes of investments that match the stated investment objective of the schemes. There are different asset classes of investments. That means where what you can take the example of a real estate industry, or you can take the what gold bonds. There also this money can be invested in the stock market. Uh, then income and gains from these investments are passed on to the unit holders based on the proportion of the number of units they own.
Sir,
Now, yes.
asset classes of investment match the stated investment objectives of the scheme. Can you explain it again, sir?
By that, you see, asset classes of investment means any investment which directly or indirectly involves certain asset. जैसे कि suppose आपका gold bonds होता है, ठीक है, और real estate bonds होता है, और real estate stocks होता है, that involve any asset. Okay, and it matches the stated investment objective of the scheme. Suppose the scheme's objective is to to take less risk and medium return, then it will matches that. Otherwise, what, if you will invest in the equity only, then what, our objective will not be the what same. That means it never matches the stated investment objective of the scheme. That is why basically asset classes of investments, if it involves certain assets, then there is a guarantee that the entire amount may not vanish. There are chances that we may get something. अभी अगर देखो आप, क्या होगा कि आपके पास सपोज 50 लाख है, तो ये 50 लाख के लिए आपके पास अपॉर्चुनिटी क्या है, आप एक मकान खरीद सकते हो, ठीक है, और क्या कर सकते हो, आप उसको स्टॉक में लगा सकते हो। एक बार सोचो, अगर स्टॉक में लगाया और कुछ मार्केट क्रैश हो गया तो एंटायर फंड चला गया। लेकिन अगर आपने मकान खरीदा तो मकान जो खरीदा तो कुछ ना कुछ तो मिलेगा, मार्केट जितना खराब होने से भी तो आपको कुछ तो मिलेगा ना।
Yes, sir.
तो सिमिलरली जो रियल एस्टेट में अगर आप जो पैसा लगाओगे, ठीक है,
Yes,
जो
sir.
रियल
Yes,
एस्टेट में जो पैसा लगाओगे, तो ये हो गया एसेट क्लास ऑफ इन्वेस्टमेंट। तो ये मैच करता है, क्या होता है कि हमारा जो ऑब्जेक्टिव होता है, जिसमें कि हम चाहते हैं कि हमारा रिस्क मिनिमम हो और रिटर्न मैक्सिमम हो। If return will not be maximum or moderate, then also it's okay, because we are not ready to take the entire risk of losing the entire amount. Okay,
Yes,
this
sir.
is actually
Okay,
basic purpose of the mutual funds. And
Okay,
income
sir.
and gains from these investments are passed on to the unit holders based on the proportion of the number of unit they own. As I told you earlier, according to the proportion of the units hold by the members. Whatever the income, that will be divided and they will get a share of that. Right? This is the
Excuse me, sir.
fundamental. This is the
Excuse me.
fundamental of your this
Excuse me, sir. Sir, if we take
detail.
in diversified investment, sir, diversified investment.
Diversified investment. Very good. Actually, in the diversified investment means, suppose you see there are 4 or 5 opportunities for you to invest. We can take the example, suppose आज का मार्केट कंडीशन देखे तो आज सपोज रिलायंस आज मार्केट में हम देख रहे हैं कि उसका बुलिशनेस है, ठीक है। तो हम हमारे पास जितना पैसा है, आपके पास मानो अभी 5 लाख है, तो आप क्या कर सकते हो, एंटायर फंड आप रिलायंस में लगा दोगे। अगर एक रिलायंस में लगा दोगे, ये भी हो सकता है कि रिलायंस कंपनी का आप आज देख रहे हो कि बुलिशनेस है, लेकिन इमीडिएटली कुछ मार्केट कंडीशन खराब हो गया और द मार्केट क्रैश हो गया, तो मार्केट पीछे चला गया, तो आपका क्या हुआ, तो आपका तो कैपिटल से भी कुछ चला जाएगा, प्रॉफिट तो नहीं होगा, वो बात छोड़ो, प्रॉफिट के बाद छोड़ो, लेकिन क्या होगा, आपका जो कैपिटल आपका इरोजन हो जाएगा, दैट इज इरोजन ऑफ कैपिटल। अभी हमें फर्स्ट ऑब्जेक्टिव क्या होता है, शेयर मार्केट में हम जब ट्रेड करते हैं तो हमारा ऑब्जेक्टिव होता है टू प्रोटेक्ट द कैपिटल फर्स्ट। तो कैपिटल आपके पास रहेगा तो आप कुछ इनकम करोगे, बट कैपिटल अगर नहीं रहेगा तो इन्वेस्टमेंट क्या करोगे। तो इसीलिए प्रोटेक्ट करने के लिए हमें क्या करना चाहिए, हमें जो देखना है कि भाई एक जगह पर लगाओगे तो वहां कुछ खराब हो सकता है, इसीलिए वेरियस अपॉर्चुनिटीज आर देयर। रिलायंस में कुछ इन्वेस्टमेंट कर सकते हो, देन बैंकिंग स्टॉक्स में कुछ इन्वेस्टमेंट कर सकते हो, देन कुछ आप जो होता है जैसे कि मेटल होता है, मेटल में कुछ इन्वेस्टमेंट कर सकते हो, और पेट्रोलियम में कुछ इन्वेस्टमेंट कर सकते हो, डिफेंस बॉन्ड में कुछ इन्वेस्ट कर सकते हो। तो इसमें क्या होगा कि सबका रिस्क अलग अलग होता है, तो एक में अगर ज्यादा रिस्क हो गया तो आपका रिस्क इन टोटल क्या होगा, टोटली मैनेज हो जाएगा। टोटली जो ज्यादा रिस्क होने से क्या होता है कि एंटायर फंड आपका वैनिश हो जाएगा। दैट इज व्हाई इट इज रिक्वायर्ड दैट वी शुड नॉट इन्वेस्ट द एंटायर अमाउंट इन ए पर्टिकुलर स्टॉक, और पर्टिकुलर कंपनी का स्टॉक चाहे हो या पर्टिकुलर इंडस्ट्री का स्टॉक हो। Easily, there are we should find out what are the various opportunities where we can get the maximum return as compared to their interest, and we should invest our fund accordingly, not in one. If we are investing one, that is not diversification. If we are investing in variety of the opportunities, investment opportunities, that is what a diversified investment. Now it is clear, this concept?
Yes, sir. Yes, sir. Thank you, sir.
सर
Yes, yes,
डाइवर्सिफाई ଯଦି କରିବା
yes.
ମାନେ କେତେ ଗୁଡେ ସେକ୍ଟର ବି ଅଛି ନିଫ୍ଟି ଭିତରେ, ଯେମିତି କି ଆଇଟି ଅଛି, ଫାଇନାନ୍ସ ଅଛି,
Yes. Actually, you
ତ
see,
ସବୁ
in the same day, जदि आमे देखिया स्टॉक मार्केट गोटे दिन रे जेतेबेले सब मूवमेंट दिए, actually all the companies they are not giving the same movements. जदि आपनकर आईटी इंडस्ट्री जदि देखिया आईटी इंडस्ट्री स्टॉक टेक फॉर एग्जांपल आपनकर इन्फोसिस, एचसीएल टेक, विप्रो, एमानकर देखिए मूवमेंट ता गोटे स्टाइल रहिथिबो, whereas देखिए रिलायंस रो मूवमेंट अलग स्टाइल रहिथिबो, whereas जदि देखिए आपण एचसीसी सीमेंट हो बा आपनकर जो रहला अलगा जे कोनसी सीमेंट इंडस्ट्री स्टॉक देखिए तार मूवमेंट अलगा रहबो, लिटिल बिट डिफरेंट रहबो। काहे व्हाई, बिकॉज़ मार्केट कंडीशंस दे गिव द मूवमेंट अकॉर्डिंग टू द मार्केट कंडीशंस। That is why all these type of investment opportunity they do not inculcate the same risk. सबका सेम रिस्क एक दिन में नहीं होता है, समझ
सर
में आ
ଆଉ
रहा है।
ଗୋଟେ କଥା।
हाँ हाँ
ହଁ
बोलो।
सर ଇଏ ଏଫଏମସିଜି ସେକ୍ଟର ଟା ତ ବହୁତ ୱେଟେଜ ଅଛି ବି, ତାର ଭଲ ୱେଟେଜ ଅଛି, କିନ୍ତୁ ଯେମିତି ଆଇଟି ହଉ କି ଯେମିତି ଅଟୋ ହଉ ଯେମିତି ବୁମ୍ କରୁଛି, କିନ୍ତୁ ଏଫଏମସିଜି କାଇଁ ବୁମ୍ କାଇଁ କରୁନି।
हाँ, very good thing. You see, people actually what they understand that this is the safest one. जो FMCG होता है safest one. People they are thinking like that. As a result, what most of the investors they are investing their fund in that. So यहाँ पर क्या हो रहा है, अगर आप सोचो आपको अगर इजी में पैसा मिल जाएगा तो आपको क्या होगा, उसका डिमांड क्या होगा, कम होगा या नहीं, समझ में आ रहा है ना। तो अभी डिमांड कम होगा, तो डिमांड कम होगा तो मार्केट में बूम नहीं होता है, क्योंकि मार्केट में जो स्टॉक प्राइस जो डिटरमिन होता है अकॉर्डिंग टू द डिमांड एंड सप्लाई। यहाँ पर क्या होता है कि रिस्क फैक्टर बहुत कम होता है, दैट इज व्हाई देयर इज ए वेरी गुड डिमांड। तो डिमांड अगर यहाँ पर क्या होता है, पीपल दे आर थिंकिंग दैट वेदर देयर इज ए गुड डिमांड और नॉट, बट विल इन्वेस्ट इन दैट। ओके, दैट मीन्स सफिशिएंट फंड विल बी फ्लोडेड टू दैट, सो देयर इज नो प्राइस इंक्रीज। अभी आपका अगर मार्केट में ज्यादा डिमांड, मार्केट में अगर क्या हो रहा है कि व्हेनेवर एवरीबॉडी नीड टू परचेज दैट, तो क्या होगा उसका?
बूम करेगा।
नहीं 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 नहीं, यहाँ पर बूम
प्राइस
नहीं
कम हो
करेगा।
जाएगा।
देखो अभी अभी क्या है कि जो ये सब जो मार्केट होता है, पीपल दे नो दैट दीज आर द सेफेस्ट, दैट इज व्हाई दे आर इन्वेस्टिंग देयर मनी, नॉट बिकॉज ऑफ द गेटिंग हाई रिटर्न। जैसे कि हाई रिटर्न के लिए अभी क्या होगा, आप देखोगे जैसे कि आपका आ रहा है जो डिफेंस स्टॉक आता है, जैसे कि एक एग्जांपल देता हूँ आपको, भारत फॉर्ज लिमिटेड। ये कंपनी देखोगे आपकी ईच एंड एवरी डे ये देता है आपका 100 150 200 लाइक 200 पॉइंट्स और 150 पॉइंट्स मूवमेंट देता है इन द सेम डे। दैट मीन्स दीज आर volatile दिस volatility इट स्टडीज द इम्पैक्ट ऑफ द मार्केट। इसमें कंज्यूमर का जो होता है मार्केट में आपका जो डिमांड एंड सप्लाई का रेशियो ये होता है, जिसका रेशियो जितना ज्यादा होगा उसका वोलाटिलिटी उतना ज्यादा होगा। लेकिन यहाँ पर वोलाटिलिटी कम होता है, किसमें? एफएमसीजी में वोलाटिलिटी कम होता है, इट इज क्वाइट स्टीडी स्टॉक। समझ में आ रहा ना? इट इज क्वाइट स्टीडी स्टॉक, people they know
सर
that these stocks will not move so much, so those who wanted to be safe, they are only purchasing that, but those who don't need what this, they think that if we'll invest in this fund then what, एक दिन में ज्यादातर होगा क्या, 4-5 पॉइंट या 10 पॉइंट मैक्सिमम 10 से 12 पॉइंट होगा। तो अगर 100 शेयर होगा तो 1000 to 1200 यू विल गेन। इसके कंपैरिजन में अगर भारत फोर्ज का आप परचेज करोगे तो उसमें आपका ज्यादा प्रॉफिट होगा, क्योंकि एक दिन में मूवमेंट उसका आ जाता है अप्रोक्सीमेटली 150 120 पॉइंट्स। ओके, अभी देखो रिलायंस भी आपका थोड़ा ज्यादा मूवमेंट भी दे रहा है, ये आपका स्टार्टिंग फ्रॉम 35 टू 70 80 90 तक भी मूवमेंट देता है। और कुछ सिलेक्टेड भी कंपनीज है, जैसे कि आपका देखो ये दे रहा है आपका कोटक बैंक दे रहा है मूवमेंट ज्यादा, और आपका दे रहा है भारत फोर्स तो एक एग्जांपल दिया, रिलायंस दिया है, हीरो हीरो
हाल
हीरो
भी दिया है।
हाँ हीरो मोटर कॉर्प, देन आपका मारुति भी दे रहा है, और आपका महिंद्रा एंड महिंद्रा, एचसीएल टेक, विप्रो,
टाटा मोटर्स।
इन्फोसिस, टाटा मोटर्स,
अरे
ये सब।
इन्फोसिस टोटल दौनी सर,
क्या क्या?
इन्फोसिस टोटल रिटर्न दौनी।
टोटल रिटर्न दौनी, जो 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 दिन
ତିନି
ଚାଲେ।
ଚାରି ମାସ ହେଲାଣି ମୁଁ
ନା ନା ନା
3 ବର୍ଷ ହେଲାଣି ମୁଁ ପକେଇଲିଣି କିଛି ଟୋଟାଲ ରିଟର୍ନ।
ନାଇଁ ନାଇଁ ଶୁଣନ୍ତୁ, ମୁଁ ଆପଣଙ୍କୁ କହିଦଉଛି, ଇନଫୋସିସ ଆପଣଙ୍କର ମୁଭମେଣ୍ଟ ଦିଏ, ଆପଣଙ୍କର ଦେଖିବେ ଆପଣ ଇଣ୍ଟରନ୍ୟାସନାଲ ମାର୍କେଟରେ ଗୋଟେ ନାସଡାକ୍ ଗୋଟେ ଅଛି, ବୁଝିପାରିଲେ ତ?
ହଁ
ଇଣ୍ଟରନ୍ୟାସନାଲ
ସାର୍
ମାର୍କେଟ।
ଆମେରିକାର ଆମେରିକାର ନାସ୍ଡାକ୍।
ତେଣୁକରି ନାସଡାକ୍ ର ରିପ୍ଲିକେସନ ଆପଣ ପାଇବେ କୋଉଠି? ଇଣ୍ଡିଆନ ଷ୍ଟକ୍ ମାର୍କେଟରେ, ଦ୍ୟାଟ୍ ଟୁ ଆଇଟି ଇଣ୍ଡଷ୍ଟ୍ରି ଉପରେ। ନାସଡାକ୍ ଯଦି ଯୋଉ ଦିନ ଚାଲିଥିବ ତା ପରଦିନ ଦେଖିବେ ଆପଣଙ୍କ ଆଇଟି ଇଣ୍ଡଷ୍ଟ୍ରି ସବୁତକ ଆପଣଙ୍କର ଇନକ୍ଲୁଡିଂ ୱିପ୍ରୋ, ଏଚଏଲ ଟେକ୍ ଆଉ ଇନଫୋସିସ ସବୁ ଦେଖିବେ ଆପଣ ଚାଲିବ ମାନେ ସାଂଘାତିକ ଚାଲିବ। କିନ୍ତୁ ଯୋଉ ଦିନ ନାସଡାକ୍ ଖସିବା, ଆଉ ଦେଖନ୍ତୁ ଇଣ୍ଟରନ୍ୟାସନାଲ ମାର୍କେଟରେ ଆପଣ ଦେଖିବେ ନାସଡାକ୍ ଗୋଟେ ଦିନ ଯଦି ପଜିଟିଭ ମୁଭମେଣ୍ଟ ଦେଲା, ପଜିଟିଭ ମୁଭ ଦେଲା, ପାଖାପାଖି ବୋଧେ ତାପରେ 3-4 ଦିନ ପର୍ଯ୍ୟନ୍ତ ଆପଣ ନେଗେଟିଭ ମୁଭମେଣ୍ଟରେ ରହେ। So these are
ସାର୍
certain trends. These are certain trends we need to understand them. Why? Because this is highly volatile. जब अब देखेंगे अगर आप ये जो स्टॉक होता है आईटी स्टॉक्स, these IT stocks are highly volatile.
ସାର୍ ଯଦି ମାନେ ଡଲାର ଷ୍ଟ୍ରଙ୍ଗ ହଉଛି ତ ଆଇଟି ତ ବଢିବା କଥା କି?
ନାଇଁ 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 ନାଇଁ, ଶୁଣନ୍ତୁ, ଡଲାର ସହିତ ସେମିତି ଡାଇରେକ୍ଟ ରିଲେସନ ନାହିଁ ଆଇଟି ର। ଡଲାର ସହିତ ଆମେ ଡାଇରେକ୍ଟଲି ତାକୁ ରିଲେଟ କରିପାରିବାନି, ଦେୟାର ଆର୍ ଭାରିୟସ୍ ଅଦର ଫ୍ୟାକ୍ଟର୍ସ। there are various factors किंतु आमे देखुचे गोटे मेजर कंट्रोलर हिसाब रे बर्तन आमे देखुचे जे यूएसए गुरी होची that means सब आमे टोटल आईटी इंडस्ट्री इज माने इज नॉट अंडर द कंट्रोल ऑफ यूएसए अदर कंट्रीज भी रहउछंती ना तेणु करी हाँ सेटा गोटे फैक्टर आपण कहउछंती जो डॉलर का दैट इज वन फैक्टर किंतु से गोटे फैक्टर तो माने नॉट सफिशिएंट to move the prices up and down of the IT stocks. Okay.
Yeah.
Yeah, particularly if you want to invest in a particular stock, जैसे कि सपोज इन्फोसिस का आप ये करोगे तो पूरा उसका आप लास्ट 1 ईयर का पूरा डाटा ले जाओ, डाटा लेके स्टैटिस्टिक्स ये करो, व्हाट आर द पॉसिबल कभी कभी उसका जो फेजेस होता है, एक फेज होता है वो फेज में देखोगे कंटिन्यूअस मूवमेंट देता है और एक फेज है जो कंटिन्यूअस देखोगे कि डाउनवर्ड मूवमेंट दे रहा है। ये सब मूवमेंट को अंडरस्टैंड करने के लिए क्वाइट विजिलेंट रहना चाहिए और मार्केट का भी बहुत कंडीशन खराब होता है। अभी आईटी इंडस्ट्री मोस्ट ऑफ द टाइम खराब रहता है, इसीलिए इट इज बिकमिंग लिटिल बिट रिस्की टू इन्वेस्ट इन द आईटी सेक्टर, राइट?
Okay, sir. Thank you, sir.
Now incomes and gains from the investments which are passed on to the unit holders based on the proportion of the numbers of the units the unit holders own. This is the fundamental of actually your this mutual funds. And mutual funds are institutions that are mobilizing. एक मिनट, क्या फिर से प्रॉब्लम हो रहा है? Please give me two minutes. Okay. So we'll continue.
Yes, sir.
Yes, sir. Yes, sir.
So already I have discussed a lot regarding these mutual funds. So let us understand again the same problem. I said this laptop giving certain issues. So please hold on. Okay, so the screen is visible.
Yes, sir.
Uh, okay, tell me which is the first mutual fund company in India?
UTI.
Yes, it is on the screen now. Okay, so UTI, that is Unit Trust of India, is the first mutual fund in India, and it was established in 1964. So UTI launched the scheme of Unit Scheme 64, the first scheme, and slowly the mutual fund growth scheme was launched in 1986. And after this success, now many other institutions, financial institutions, particularly the banks, SBI mutual funds, Can Bank mutual funds, LIC of India, everybody entered into this field. And the private sectors are also entered in the mutual fund industry, and at present there are 40 mutual fund companies in India. So these benefits we'll discuss later on. let us first understand the types of a mutual fund. There are various tools for investing money, such as bank deposits, metals, real estate, and stock market instruments. जैसे कि स्टॉक मार्केट में हम क्या देखते हैं कि आईटी इंडस्ट्री, जैसे आपका रियल एस्टेट, देन मेटल्स, देन बैंक्स, then stock market instruments. So different opportunities are there. And the scale of risk and return is based on the type of investment. Investors should trade off between the risk and return. And if they invest in the bank deposits, then the risk is very low, and at the same time the return is also very low than that of any other means of investment. And the metals and the real estate, the assets are not sold easily. Why? Because you see, these assets, once you purchase these assets, then it takes certain time for the purpose of liquidation. The expectation of the investor is high return with a low risk, and a low risk with a optimum return, and within a short period of a time, which is possible only in the stock markets and not elsewhere. And it is possible only in the stock market investment, but it is not possible to the common investor because he is not technically competent to understand the stock market operations. Why? You see, the common man can invest his money safely in the stock market through the rescuer, that is mutual funds. Now I am giving you one example. Suppose you don't know swimming, and but you wish to swim in the sea. Then what? You must take the help of the helper. That is what a teacher जो होते हैं कि swimming के लिए instructor होते हैं. You should rely upon them, and they only help you. So these are called your rescuer. And in the particularly whenever you want to trade in the stock market without having sufficient knowledge regarding the stock market, then you should take the help of these rescuers, and these rescuers are your mutual funds. So an investor can invest in the mutual fund at a lower cost with the advantages of a diversification, which I made you clear earlier. And diversification means what? Spreading out money across many different types of investment. Already I have given you the example and I made it clear. And when one investment involves a high risk, another might be little bit lower. So diversification of investment holding reduces the risk tremendously. And on this basis of their structure and objective, mutual funds can be classified into various types. There are two types. One is open-end mutual fund, another is your closed-end mutual fund, which also we had discussed in the previous class, but still again we are revising it. But I think that if people are not clear in these two concepts, open-end mutual funds. An open-end fund or scheme is one that is available for subscription and repurchase on a continuous basis. That means whenever you want, you can enter, and whenever you want, you can also exit from that mutual fund. And this facility is available only in case of an open-end fund. And these schemes, they do not have a fixed maturity period. So here what is happening? The investors can conveniently buy and sell units at the net asset value, which is the related price, and which are notified on a daily basis. Right? This is the concept of your open-end mutual funds. Another is your closed-end mutual funds. Here you see closed-end fund means it has a stipulated maturity period. You can take the example of a 5 years or 7 years like that. And this fund is open for subscription only during a specified period at the time of a launching of the scheme. And investors can invest at the time of initial public issue, and thereafter they can buy or sell the units of the scheme through the stock exchange where the units are listed. Because it will take certain time for listing and there is a lock-in period. So एक बार आपने उसको परचेज कर दिया तो आपका ये लॉक-इन पीरियड जितना होता है उसी तक ये आपका स्टिपुलेटेड हो जाता है. बट द सेबी, यस
सर, इसका मतलब ओपन एंड में रिटर्न कम ही होगा और क्लोज एंड में ज्यादा होगा?
नहीं, ऐसा नहीं है, ऐसा नहीं है, ऐसा नहीं है. क्या होता है कि देखो, जो क्लोज एंडेड म्यूचुअल फंड्स होता है, इट गिव्स स्कोप टू द फंड मैनेजर better scope for the long term return. तो लॉन्ग टर्म रिटर्न के लिए बेटर स्कोप देता है, सो दैट दे आर प्रॉपरली प्लानिंग हाउ टू इन्वेस्ट योर फंड. लेकिन यहाँ पर ओपन एंड में क्या होता है, एक्चुअली दे आर नॉट श्योर दैट वेदर यू विल लेट योर फंड डिपॉजिटेड देयर और यू विल विथड्रॉ योर फंड, so that they are not able to exactly manage your fund. That is the problem they are facing.
सर अगर मैं 3 साल के लिए कर लिया फिक्स मान लो लॉन्ग टर्म में, अगर
हाँ
एनी
हाँ.
केस हाउ आई नीड टू जस्ट रिडीम दैट, इज दैट पॉसिबल? आई थिंक बोले एग्जिस्टिंग टैक्स समथिंग लाइक दैट विल बी एप्लीकेबल फॉर दैट, am I right?
You see, there are actually two practical difficulties are there. What is the
Okay.
practical difficulty? Actually, market में कभी कभी देखते हो कि कभी कुछ कुछ पीरियड के लिए मार्केट में टेम्पररी बुलिशनेस होता है और टेम्पररी के लिए भी बेरिशनेस आता है. जैसे कि आप अभी बताओ, अभी 2 महीने के पहले क्या था, मार्केट का कुछ बहुत खराब हो गया था और
हाँ
अभी रिकवर कर गया. तो ये
हाँ
क्या होता है, म्यूचुअल फंड में हम लोग क्या करते हैं, जब देखते हैं कि हमारा टोटल वैल्यू जो होता है वो कम हो जाता है, हमको डर लगता है कि भाई हमारा ये पैसा डूब जाएगा, तो उसको निकाल देते हैं. लेकिन निकालने से कुछ फायदा नहीं. वी हैव टू वेट फॉर द लॉन्ग टर्म, क्योंकि जो म्यूचुअल फंड्स में अगर आपको पैसा डालना है तो लॉन्ग टर्म यू शुड थिंक अबाउट दैट. तो लॉन्ग टर्म में क्या होगा, आपका पैसा डूबेगा नहीं, रिटर्न कुछ जरूर आएगा.
नहीं
लेकिन
सर,
शॉर्ट टर्म में क्या होता है, शॉर्ट टर्म में ज्यादा प्रॉफिट का चांसेस भी है और नुकसान का भी चांसेस ज्यादा होता है, विच इज द केस ऑफ योर ओपन एंड म्यूचुअल फंड्स.
सर वो
सर
समझ गए बट
ओपन एंड
सर,
में
Yes, 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 just one by one, please tell.
sir, I got your point, but I just wanted to know if there will be any needed, I mean, funds I require for any emergency. So, is that possible? Can I that withdraw that amount or not? Suppose I just invested it today, that will be for 3 years, but
हाँ
after 1 year there will be needed. It was long term. I'm not sure short term, right? And
हाँ.
if funds is required by me, is that possible? Can I withdraw it for 3 years? Is there in rules and regulation for that? I think so. I just
Ah,
want to.
yes, 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 yes. Actually, you see, there is a procedure. Actually, previously तो नहीं था. अभी क्या हुआ, जो सेबी wanted there should be some exit in the
So I
closed-ended
think
mutual fund.
exist tax something like that, right, sir?
हाँ हाँ हाँ, वही वही बता रहा हूँ.
Okay, okay.
एक्चुअली अभी जो सेबी जो रेगुलेशन किया है, तो सेबी बता रहा है तो कुछ ना कुछ एग्जिट एग्जिट हुए चाहिए, क्योंकि अगर कोई बंदा उसमें इन्वेस्ट कर रहा है, तो इतना पैसा इन्वेस्ट कर रहा है, तो उसका भी तो कुछ इमरजेंसी होगा ना.
Correct,
तो
correct.
कुछ ना कुछ स्कोप होना चाहिए. वही तो मैं आगे जाकर बताऊंगा आपको. अभी देखिए क्या होता है, क्लोज एंडेड का मतलब क्या होता है. एक्चुअली क्लोज एंडेड जैसे वर्ड से हमें पता चल जाता है कि इसका जो टू एंड होता है वो क्लोज होता है. इसका मतलब ओपनिंग जो कंपनी देता है उसी टाइम आपको इन्वेस्टमेंट करना है, और उसका जो लॉक इन पीरियड होता है, लॉक इन पीरियड खत्म होने के बाद ही आपका मैच्योरिटी करता है. ठीक है. और
Okay,
उसके बाद भी आप रख सकते हो, लेकिन उससे पहले नहीं निकाल सकते हो, उसको लॉक इन पीरियड बताते हैं.
correct,
लेकिन
correct, correct.
ये जो पहले कंसेप्ट था, लेकिन जब एक्चुअली जो कंपलसरी बता देता कर दिया, आपका जो सेबी कंपलसरी कर दिया, म्यूचुअल फंड सारे म्यूचुअल फंड्स वाले सेबी में रजिस्टर करेंगे, तो सेबी बोल रहा है भाई ये जो इन्वेस्टर्स है उनको आप एग्जिट के लिए कुछ कुछ ना कुछ वे दो. आइदर एक भी तो रास्ता है उनको चाहिए कि एग्जिट करने के लिए, क्योंकि कुछ का भाई किसी का इमरजेंसी होगा तो उसको भी मिलना चाहिए. तो अभी देखो नेक्स्ट स्लाइड में देखो, मैं वही बता रहा हूँ.
Sure, sure, sir. Got it, sir. Actually, I just this thing and in my mind is that's why I thought I'd discuss with you.
हाँ हाँ. ओके ओके.
Okay, thank you.
एक्चुअली टुडे व्हाट इज हैपनिंग आई डोंट नो, बट ये मेरा लैपटॉप कभी इतना भी धोखा नहीं देता था, लेकिन आज इतना बार धोखा दे दिया.
Okay.
सर
हाँ हाँ.
सर
यस.
आप जैसे बोले कि ओपन म्यूचुअल फंड में ज्यादा भी दे सकते हैं और कम भी दे सकता है, तो वो कैसे होगा सर? ज्यादा मतलब कैसे ज्यादा दे देगा
हाँ
या फिर
हाँ.
कम?
अभी अभी देखो मैं आपको बता रहा हूँ. मैं एक एग्जांपल लेके चलो, मैं स्टॉक मार्केट का एग्जांपल दे रहा हूँ. अभी सपोज रिलायंस रिलायंस में मैं आज आज के डेट में परचेज किया, सपोज 100 शेयर्स परचेज किए. ठीक है. और उसका वैल्यू है अभी सपोज 3000 लेके पकड़ो, एक स्टॉक का वैल्यू 3000 लेके पकड़ो, तो 100 शेयर परचेज कर दिया, यानी कि 3 लाख. तो मेरा 3 लाख इन्वेस्टमेंट हो गया. और कल क्या हो रहा है कि कल आप जो फास्ट आवर में जनरली मॉर्निंग में एक फास्ट आवर में एक अच्छा मूवमेंट देता है, ठीक है। वो अच्छा मूवमेंट में सपोज मार्केट आपका अपवर्ड मूवमेंट दे दिया, आपका 100 रुपीज तक मूवमेंट आ गया, ठीक है। तो मेरा मेरा कितना प्रॉफिट हो गया? 10,000।
Yes, sir.
अभी ठीक है। तो आप अगर सोचोगे कि भाई एक दिन में तो 10,000 हो गया, लेट द फंड टू बी इन्वेस्टेड देयर। अभी क्या होगा कि आप पूरा दिन भर आप देखें कि मार्केट जितना ऊपर गया था, तो उतना नीचे गिर गया। सुबह जितना ऊपर गया था उतना नीचे गिर गया। उसके बाद आप 3-4 दिन तक देखोगे कि कंटिन्यूअसली मार्केट गिर गिर रहा है।
Yes, sir.
तो इसे क्या होगा? आपको पैसा आपका लेना जरूरी है, तो आप क्या करोगे? तो मार्केट में लॉस में भी तो मार्केट से निकलोगे ना, तो आपका कैपिटल भी इरोजन हो सकता है।
तो लेकिन हम वेट भी तो कर सकते हैं ना वो बढ़ने तक।
हाँ, हाँ, वेट कर सकते हो। एक्चुअली देखो क्या होता है कि हमारे पास जो फंड होता है वो लिमिटेड होता है, ठीक है। एंड ये जो फंड लिमिटेड होता है, ये जिसके पास सरप्लस फंड होता है, तो सरप्लस फंड होने से क्या होता है कि हम म्यूचुअल फंड्स में डाल देते हैं। इसमें क्या होता है कि जो थ्रू एसआईपी, जो कि क्लोज एंडेड होता है, इसमें क्या होता है कि आपका लॉक इन पीरियड 3 इयर्स या 4 ईयर या 5 इयर्स होता है। और ये 4-5 साल के बाद क्या होता है, एक स्टैंडर्ड रिटर्न जो कि वो कमिट करते हैं आपको कि हम आपको 8% देंगे या 12% देंगे या 13% देंगे, वो उतना दे पा रहे हैं। वाई? क्योंकि उनके पास जो आपका जो पैसा जा रहा है, ये जो फंड है, वो फंड को उनको पहले पता होता है कि हमारा इस दिन को इतना फंड होगा। तो किसी दिन कितना फंड उनको यूटिलाइज करना है वो प्रॉपरली जान लेते हैं, इसीलिए वो प्रॉपर प्लानिंग करते हैं और उसको डाइवर्सिफाइड इन्वेस्टमेंट करते हैं सो दैट टू गेट द मैक्सिमम रिटर्न। लेकिन आपका ओपन ओपन एंड में क्या होता है, आप जो इन्वेस्टमेंट किए हो, जो पैसा, हो सकता है आप आज इन्वेस्टमेंट किए हो, कल आप बताओ कि भाई मेरा जरूरी है मैं ले जाऊंगा, तो ले आए। तो इसे क्या होगा कि द फंड मैनेजर्स दे आर नॉट efficiently able to plan where to invest it. That is why they are facing difficulty and they are not properly able to invest your fund. इसीलिए क्या होता है कि वहां पर कुछ गारंटी नहीं होता है। ओपन एंड में वो ज्यादातर गारंटी नहीं देते कि कितना परसेंट आपको मिल सकता है। कम भी हो सकता है, ज्यादा भी हो सकता है। कैसे ज्यादा होगा मैं बता दिया आपको, और
Yes, sir.
कम होने का तो मैक्सिमम चांसेस है। लेकिन जो होता है आपका क्लोज एंडेड में क्या होता है, यहाँ पर आपका स्टिपुलेटेड टाइम होता है। उसको पता है भाई ये जो मेरा 100 इन्वेस्टर्स रहे, ये इनका 3 साल तक पैसा आएगा हमारे पास। तो इस दिन इतना आएगा, इस दिन इतना आएगा, वो प्लान करके उसके बेसिस में मार्केट ट्रेंड एनालिसिस करके, जो आपका टेक्निकल एंड फंडामेंटल एनालिसिस करके उसके हिसाब से वो उसको इन्वेस्टमेंट करते हैं। वेयर दे आर मेकिंग द प्रॉपर प्लान, दे आर इन्वेस्टिंग इट। सो डेफिनेटली जो गारंटी, वो क्या होता है आपको एक गारंटी देते हैं कि आपको हम 13% देंगे या 15% रिटर्न देंगे, वो दे पा रहे हैं। समझ में आ रहा ना?
Yes, sir.
Okay. So with this we need to conclude. Actually, I wanted today to discuss many more things, but today my laptop never support me, so that I need to conclude my class. Thank you so much.
Okay, sir. Good night, sir.
Thank you, sir.
Okay.
Good
Sir,
night, sir.
Good night.
sir,
Yes.
please share your first unit PPT with Rasmi madam, sir. First
Uh,
unit PPT.
First unit I have already sent you. Okay, I'll remind madam to share this PPT to you.
Sure, sir.
Okay,
Thank you.
sir. Okay, sir. Thank you,
Okay,
sir.
okay, thank you. Any other queries?
Thank you, sir.
Anybody?
No, sir. Thank you, sir.
Okay, thank you.
Okay. Okay.
So I'll make you host.
No, no, sir. There is no more class. You can just conclusion it.
Okay, this is the last class.
Yeah.
Acha, to,
Am I right,
madam,
friends? Friends, I think
ma'am,
this is last class, right?
uh, I, I am not sure whether another class will be there or.
Yeah, as per schedule, it was last class.
Acha, another thing, ma'am has said you that tomorrow I will take my class at 6 o'clock.
Yes, sir. We'll go with schedule. No, that's not issue. Thank you.
Okay. Okay.
Thank you, sir.